In this video, we're going to talk stocks, all things stocks. So I'm going to show you exactly what they are, what to look for when you're trying to pick some, and just a general idea of how to actually make good decisions. Over the past 100 years, absolutely nothing has given better returns than stocks. Not real estate, not gold, not platinum, nothing. Stocks have been the number one champion of building wealth over the past 100 years. So I'm going to show you my screen now. This is my trading 212 account that I've created specifically for Roadman Investor. So it just allows me to play around and I can just use it to teach and show different examples. So it's different from my bigger portfolio that I've got all my stocks in. In fact, I've got about 5 or 6 different portfolios. So straight away, you can see all these different stocks inside the portfolio. And I'll just quickly make you understand what a stock is. So a stock is basically a tiny piece of a business. So imagine you have a company and you want to raise money. So your company is doing well, but you want to expand or you want to buy new equipment or you want to invest. So you can either go to the bank and ask for a loan, or you can raise funds in other ways. So if you go to the bank, they'll say it's X, Y, and Z interest, and you'll pay over the period of time and so on. That's fine. Alternatively, you can do what's known as a IPO, initial public offering. So that's where you go to the market and you say, I got this wonderful business and I want to sell a part of it to raise some money. So say, for example, your company has 2 million shares and you want to sell half of it, so 1 million shares, and then you set a price for £1 per share. So if those 1 million shares sell, that means you've now raised £1 million. It means you don't have to go to the bank for that. But on the other side, it means that you've now sold half of your business to the public. So if someone came along and bought £500,000 worth of shares, they've bought 25% of your business. So half of what you put over there. That means that they're now part owner of that business. So every time you buy a stock, every time you buy a share, you're buying a piece of that company. You're basically becoming an owner of that company also. So that's where you have to think of it. So before you buy any share, you have to think, do I want to own this company? It's not just something you're buying in the shops, online shopping. It's not like you're buying the new jacket or shoes or whatnot. It's a real existing company that's making money and transacting. So there are 2 main types of shares or stocks. I use the 2 words interchangeably. So when I say shares or stocks, just know I'm referring to the same thing. So 2 types of stocks. The first one is known as a value stock. So value stock tend to be the older companies. So we're talking the likes of Procter & Gamble, Barclays Bank, Coca-Cola. So these are companies that have existed for a long time. They tend to be more settled. They tend to be less volatile, so the prices are not moving up and down a lot. They pay dividends a lot of the time. Usually those dividends are actually growing as well. And they're well established. So we're talking businesses that, if you go to South America, they know where they are. Coca-Cola, people know where they are. Pepsi, people know where they are. So those kind of businesses, they tend to be well priced, and compared to the earnings, it seems to be a very good ratio. So it's called the price to earning ratio. So how much the stock cost versus what they're making per year. That ratio tends to be quite low. So anything below 20 is seen as a low PE ratio, which means that it's a well-priced stock. Anything above 25 is seen as a high PE ratio. So going on to growth stocks, as the name suggests, the growth stocks are stocks that are moving very fast. They're growing very fast. So they tend to be newer companies, usually tech companies, and companies that are basically reinvesting a lot of their money. So they might be making money, but they're not often profitable for a while because they're growing fast. And every penny they make goes straight back in to reinvest, to carry on the growth. Now, they tend to be more volatile. So the price move up and down a lot. They tend to be quite expensive. So the price to earning ratio tends to be over 25 in a lot of the cases. And they tend to be non-dividend paying. So if if they pay anything, it'll be 0.01% or 0.2%, something tiny, versus the value stocks, they might pay 3, 4, 5%, depending on which one you're talking about. So depending on your strategy, what you're trying to achieve, you might want a nice balanced portfolio that's got a bit above, or you might want a growth leaning portfolio, so you'll have a lot of fast growing stocks, or you might want a value stock portfolio. So these are more balanced, more settled stocks like Coca-Cola and so on, like we discussed. So it's down to what you're trying to achieve and your kind of time frame. So the two ways to really make money from stocks are to either sell the stocks or by gaining dividends. So when you buy a share of that company and the company does well, so they've made profits for the year, they'll say, right, because you own part of the company, here's your part of the profits we make, and that's called the dividends. So dividends are either paid monthly, so every month, quarterly, so every 3 months, twice a year, so usually every 6 months, or annually, so you get just one big payout. Different companies do it different ways. Now, the thing about the dividends is that they don't always pay them. So some companies will decide not to pay them, depending on how the company is performing. If they're not profitable, then you might not get any dividends. Now, the older companies that pay dividends, growing dividends, are called dividends aristocrats. So these are companies that have paid for 25 years or longer, and the dividends have grown consistently. So if you're looking more for income, more guaranteed payments, then you might be looking more into those kind of companies. So if you're looking for something that's going to grow very fast, then you want a growth stock portfolio basically. But unless those companies start paying dividends at some point, in order to gain the money from those stocks, you will have to sell them. So just bear that in mind. So I'll give you some examples now. Looking on the screen, you've got the first one there, Palantir. If we open that up, we'll see that the Palantir stock is currently selling for $153.39 at the time of recording. Last year, it's 446.46% up. So if there was ever a growth stock, this is it right here. So if you look at the price movement over the past day, it's down 0.08%. Past week, 7.95% up, and 9.6% up for the last month, and so on. So you can see the price moves a lot with this. So that's definitely a growth stock. If you look at the average price there, so that's probably one of the most important things here. You look at this, that line there is your average price. So anything below the average price line, you're in the red. That means that you're not profitable. You're making a loss on that stock. Anything above that is basically profitable. You're in the green. So whenever you get the chance, you want to reduce that line if you can. Now, if you're taking a long-term view, then it doesn't really matter because you're just going to keep investing no matter what. But if you have a shorter-term strategy, or you just want to make as much money as quickly as you want to, you might want to dollar cost average, which means that if there was a dip, so say for example from there it went down to that bit there, you want to buy it at that lower price, which would then reduce your average price. And that means that when the stock goes back up like it's done there, your price will be here, which means that all that will be your growth rather than just that bit there. So that's one way of making money, and then you can just sell the stock and realize the profits from it. If you look on here, it shows 0.1153796 shares. Now, the reason that people are now able to invest so easily is down to the fact that there's something called fractional shares or decimal shares. So back in the day, if you wanted to invest in a share like this, a stock like this, you'd have to have $153.39 to buy a full share as a minimum. But now, if you only have, in this case, for example, just £10, you can just drop your £10 in and it'll give you £10 worth of shares. So in this case, the amount I invested gave me 0.115. So remember, this is just my roadman investor portfolio. So it's just so I can mess around and do some teachings with it and show real examples. Now you see this bit there. This is all about the social feeds and just information. So you see stuff about NATO, and so these things are some of the things that actually move the price of the stock. So you're looking at, I don't know, someone like Trump picking on Elon Musk. that would obviously have an effect on the price of that stock. And if you look at the volatility, it tells you it's a highly volatile stock. Not surprising given that it's a growth stock. The market cap is simply the number of shares in circulation. So say for example there's 1 million shares and then the price per share. So 1 million shares at £10 per share, you got £10 million. So that company is worth £10 million. So that's market capitalization. That's the PE ratio I was talking about. So you see that 631 PE ratio. We said a PE ratio of 25 or higher is high. This is 631. So this is very high PE ratio. And you can see dividend yield is 0. So you're not getting any dividends at all. If you look at the financials, so just little things to look out for as well when you're picking a stock. You want to see a general upward trend. So you see that those blue bars there, that's the revenue. So you can see that it's growing consistently from 2021, 2022, 2023, 2024. So that's good. And you can also see the net income. So this is when you take away what they made versus what it cost them to make it. So the cost of sales, they call it. So the liabilities essentially. So they made £100, but then they paid wages, they paid the suppliers, they paid all that. When you take that away from what they made, that's your net income. So in 2021, they lost money. 2022, they lost money, but that kept growing. 2023, they finally made money. And then 2024, that's growing a little bit as well. So overall revenue versus the net revenue. So that's called the gross revenue. So you want to see that kind of trend there. That's a good indication. If you want to look at the balance sheet as well, you see a similar story. So you want to see that nice upward trend. Sometimes it won't be uniform. So it's possible that a stock could have a bad year or a bad quarter. But as long as it's generally trending up, that's fine. And then you look at the cash flow as well. So it's always going to be all over the place with a growth stock because they basically throw all the money into things like operating, investing and so on, just to make sure the company keeps growing very quickly. So you look at things like net income, depreciation, all of that. Most of these things don't really make a difference to us because we're just starting up with our journey. So I'll just go back and then we'll look at an example of a value stock. So I'll pick one like, let's have a look, Johnson & Johnson. That's like perfect. So looking at Johnson & Johnson, you can see that over the past year, it's only 5.82% up. So value stock, it's not going to give you 400% up necessarily. It's highly unlikely, but it's nice and steady. You can see it's consistent. So they tend to be boring, but people like them because you know what you're going to get. So that's my average line there. So if, for example, it dropped there and I bought it, that will drop that line slightly. If it was up there and I bought more, then I'll pull the line up a little bit. So wherever you can, you want to dollar cost average is called, to lower that line. If you can't and you're on a long-term strategy, it doesn't matter anyway, just keep going. Right, so again, I own 0.008 of shares of the Johnson & Johnson. That's my average price again. If you look a little bit further down, the story couldn't be any more different if you tried. So volatility medium, nowhere near as volatile as the other one. Look at the market cap, 393 billion. Average volumes, 8.18 million. PE ratio, 17 versus 600 and whatever that one was. So you can see it's a lot more well-priced stock compared to Palantir that we looked at. And then guess what? They even pay dividends. And the dividends are growing dividends as well. So that tells you the ex-dividend date. So if you want to make dividend from this stock, you need to own the share by the 27th of August, basically. So the end of the trading day, you want to own the share to gain that the dividend payout. And it's going to be paid out on the 9th of September. So we've gone through the basics there. There isn't much more you need to know. However, as you can see, it's a bit of a headache analyzing stocks. There's a lot more to look at as well. So I'm not going to go into too much detail because it's not really required at this stage. But say, for example, you've now decided that you're going to buy a particular stock. In this example, we're going to use Coca-Cola. Now I'm going to show you exactly how to purchase the stock. So first thing you want to do is click on search, and then it takes you to this page here, and you can literally just search Coca-Cola. So you can type in Coca-Cola, and that's the one there. So now it'll give you a number of different options. Obviously, Coca-Cola is a big, massive company, so it's got many subsidiaries. As a rule of thumb, unless there's a UK version of it, i.e. a company that's based in the UK, I tend to stick to the country of origin. So this one is an American company based on the New York Stock Exchange. So that's one that I'm going to go for. So you just click on Coca-Cola like so, and you can see the buy button there. Now, bear in mind, this is a laptop. The views might be different if you're using your mobile phone, but it would be a similar layout in that there will be a buy button there somewhere. So if you just click on buy, then you get a screen like so. So you can see you got a number of options there. So this one says market, that one says limit, that one says stop, and that one says stop limit. For the sake of these videos and to kind of keep it simple, I'm only going to explain market and limit. So when you put a market order in, say for example you put £1 in there, the system will look for the nearest available price to £68. So it'll go into the market and look for anyone selling their stocks for around £68. Now, the problem with market buy is that if it doesn't find anything exactly £68, then it'll go 68.1, 0.2, 0.3. Eventually, it'll go for the nearest available stock to that price. Now, if that happens to be £68.20, then so be it. So a lot of the time you see a price on the screen, you're thinking, okay, this stock is £68. I'm going to buy £68 worth of stocks, let's say. With a market buy, that's not necessarily going to be the case. So to kind of make it a bit more guaranteed, shall we say, to control it a little bit more, you can use a limit order. So what the limit order does is you're telling the system that this is the maximum amount that I want to pay for this stock. So what you do is, instead of typing £1 like I did there, you can use this slider there, and you can see the £1 there. So this time is £1.01, close enough. And you can see the decimals. And this is also the beauty of platforms like Trading 212. You can literally buy fractional shares. So if you've only got £1 to invest, it will give you £1 worth of stocks. So fractional or digital or decimal, whatever you want to call it. It means that you don't need to have £68. You can just invest with your £1 or £2 or whatever it is you have. So once you've put that there, now you tell the system that I want to pay no more than £68, let's say. So that means that if the system looks online and is looking for different stocks and different sellers, and there isn't anyone who's selling for £68 or less, the system will not execute. It means that you may be waiting for a while before that order goes through, but it also gives you that peace of mind of knowing that you're not going to accidentally overpay for a stock. £68.20, £68.50, sometimes £69 if that's the first available one. So that's one way of protecting yourself. So once you've done that, you've told the system, I don't want to pay any more than £68. You simply click on review, and then they give you a summary. So it tells you the order type, limit buy, it tells you the number of shares you're getting, so 0.02, which equates to £1 and a penny. It's telling you the limit price you've put, so £68. And in this case, I've put expiration never. You can actually change that. So if you go back slightly, you can change that from never to end of day. So, and then it tells you, because it's Trading 212, again, it's commission free, which means that they're not charging you for this transaction. If you use certain platforms, say for example Hargreaves Lansdown, there may be charges for this. So try to get a platform that will give you commission free where possible. And then again, because it's an American stock, which means that we're having to buy the stock in US dollars using our pounds, there's going to be an exchange rate, and they're telling you there that that's the exchange rate that they've used. Now, some platforms will also charge you for the FX transaction. Trading 212 also do, but it's only a small fee that they charge. and that then gives you the summary. So in total, you're paying £1 and 1 penny, and all you have to do then is just send your order. Now, we're currently filming on a weekend, so it's a Saturday today, which means that this order will not execute until the stock market reopens on Monday. So what it will do is it will hold this, as you can see there, 1 day, 4 hours, 49 minutes. It will hold this till the market opens, and then the system will try to fulfill that at that price, £68. And if it doesn't, it'll hold it and hold it and hold it until there's a stock available for £68 or less. Because it's a limit order, it won't execute for any more than that. If you wanted to do a market order, it's the same thing, but this time around, I prefer to just use the keyboard. So just type in £1, let's say. Again, you can see it tells you how many shares that gets you, and you just click on review order, and it gives you that summary yet again. This time around, it tells you it's a market buy. It tells you the number of shares you're getting. It tells you how much it's worth. So this time it's £1 exactly. Commission free. Still again, summary of the FX rate and the total. And you just simply click on send buy order. Same thing again, because it's the weekend, that's not going to execute till Monday, which is 1 day and 4 hours and so on and so forth away. And you just simply click on OK. Now, so I've just shown you there how to literally buy a stock. So bearing in mind that once this executes, that means that you're now a part owner in Coca-Cola or whichever stock that you've chosen to purchase. It means that by definition, you own a part of Coca-Cola. You own a part of the business you just purchased. So that's the way you need to view it. So use this on any platform. Follow it step by step. It doesn't matter if it's Invest Engine or Interactive Investor. It doesn't matter. They will have a similar kind of process where you click on purchase or buy or wherever the word they use. They'll ask you how many you want to buy. Some platforms might not allow you to buy fractional shares. You might have to buy full amount of shares, which means you'll have to have the full $68 in this case. But many of the newer ones will allow you to do fractional purchases. Once you've done that, you tell it you want a market buy, in which case it'll give you the best price available at the time. Just bear in mind that it might not be the price shown on the screen. It might be a little bit more. Or you do a market order, which would mean that it won't execute for any more than the price you've put. It just means that you might wait. Now, if the price goes past $68, for example, and it never goes back down, then that transaction will not execute, in which case then you might not be able to purchase that stock. If you're happy with that, then that's absolutely fine. So I hope that helps. If you have any questions, leave all your comments below. Let me know how you're getting along. And we're going to be moving on to dividends investing. So I'm going to talk about how to make money and potentially live off dividends. That's one of the actual main, real and original forms of passive income, because once you purchase these stocks and they're spitting out dividends on a weekly, monthly, annual, biannual, quarterly, whatever it is, you can take that money, you can reinvest it, you can actually use that money, pay your bills and do whatever you want with it without having to do anything else. All you've done is purchase the stock, and the stock will then reward you for doing so. So once again, don't forget to like, share, subscribe, click on the notification, and join me again next time on The Roadman Investor.